Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Before we jump in, a quick reminder for you listening. This briefing is purely for market context and discussion, to help you understand the day's incredibly complex moves.
Right. It is not personal investment advice or investment recommendation.
Exactly. So today is Tuesday, April 7, 2026. And today's deep dive relies on our daily market recap and macro context notes to really unpack a volatile day for U.S. equities.
Yeah, the mission today is to break down the severe emotional whiplash traders experienced.
I mean, swinging from apocalyptic panic before your morning coffee to sheer relief by the closing bell.
It was intense.
It really was. And we are going to explore the fundamental logic driving those massive swings. Because there is a core tension here for you to think about. How exactly did the S&P 500 manage to close in the green on a day when the U.S. president explicitly warned that a whole civilization will die tonight?
It's the ultimate market paradox. You really have to look at how the financial system processes fear to understand it.
Right. So to untangle this, we have to start with our first session. What's at the stage before the U.S. session?
Well, to accurately frame the stage, you have to look at the carryover narrative from Monday, April 6th.
Okay.
Going into Tuesday, markets were already struggling under two very heavy structural overhangs. First, there's the ongoing issue of sticky core inflation.
Right, with the 10-year Treasury yield stubbornly sitting above 4.3%.
Exactly, which acts like gravity for the entire stock market.
Yeah.
And second, you have the looming geopolitical deadline. President Trump had set an 8 p.m. Eastern Time Tuesday deadline for Iran to reopen the Strait of Hormuz.
And for anyone who doesn't track global shipping lanes, the Strait of Hormuz is the central artery for global energy.
Yeah, if it stays closed, global oil supply plummets.
Right. That deadline was a ticking clock hanging over every trading desk. And while it was ticking, the geopolitical escalation overnight was just relentless.
It really was.
So imagine you are watching the terminals late Monday night. At 11 p.m. Eastern Time, which was 6 a.m. local Arabia Standard Time on Tuesday, Iran launches 7 ballistic missiles at Saudi Arabian energy facilities.
And the Saudis did report intercepting those missiles, along with 4 drones.
Right.
But debris was falling near highly sensitive areas, so that immediately spikes the risk premium for global energy infrastructure.
Because the market is pricing in the probability of physical destruction, and the escalation didn't stop there. By midnight Eastern Time, or 7:30 a.m. local Iran Standard Time, U.S. forces conduct restrikes on military targets on Iran's Kharg Island.
Which is the beating heart of their oil export infrastructure.
Exactly. Then, just an hour later at 1 a.m. Eastern Time, further airstrikes destroy Iranian highway bridges and a train station.
Signaling a serious widening of the operational scope.
Yeah, I mean, if I am a trader watching this at 1 in the morning, my immediate thought is that global oil supply is about to choke. How does the market even price in a literal war over oil when inflation is already a problem?
Well, the calculus is grim. Every single one of those overnight strikes mathematically increases the probability of a catastrophic disruption to the global energy supply.
Right.
And if oil shoots up, that sticky inflation becomes entrenched. It forces central banks to keep interest rates higher for longer.
Which squeezes economic growth. But amidst this literal threat of war, we get a totally different, almost surreal headline.
Well, the M&A news?
Yeah. At 2:30 a.m. Eastern Time, so 8:30 a.m., local Central European Summertime Pershing Square submits a massive $64 billion takeover bid for Universal Music Group in Europe.
Sending UMG shares soaring over 11% in Amsterdam.
Which is crazy. I have to push back on the psychology here. You have missiles flying over oil hubs on one screen and a $64 billion music industry buyout on the other. How does a trader even begin to process these completely divergent signals before the opening bell?
It creates profound cognitive dissonance. I mean, the Pershing Square bid tells you that beneath the geopolitical terror, large-scale financial machinery is still turning.
Capital is still looking for deployment.
Exactly.
Yeah.
Traders generally process this by compartmentalizing. The Universal Music Group news is an idiosyncratic, single-name event. But the missiles over Kharg Island, well, those represent a systemic macro event.
And systemic fear always dictates the broader market sentiment.
Always.
Which brings us to the absolute breaking point, because whatever comfort the market took from that M&A activity completely evaporated at 6:40 a.m. Eastern Time.
Right. That is when President Trump delivered his stark ultimatum.
Yes, stating that a whole civilization will die tonight if his deadline wasn't met. So you have a barrage of overnight missile strikes compounded by early morning rhetoric warning of global destruction.
It was a terrifying setup for the New York Open.
It really really was. We will take a quick break, and when we come back, we'll dive right into the opening bell.
Sounds good.
All right. All right, we are back. So following that terrifying overnight setup, we have to ask our next question. What moved markets during U.S. trading hours?
Well, given the apocalyptic setup, the immediate reaction at 9:30 a.m. was incredibly brutal.
Yeah.
Peak risk-off behavior took hold right out of the gate.
Yeah, the S&P 500 plunged as much as 1.2%. The Dow dropped over 400 points.
And WTI crude oil spiked above $117 a barrel intraday.
As traders rushed to hedge against a severe energy supply shock, I want to spend a minute here because it's crucial for you listening to understand the mechanics of this plunge.
Yeah.
Why do equities fall so sharply and uniformly across the board?
It comes down to something called the equity risk premium, or ERP.
Right. Can you break down how that math actually works when panic sets in?
Sure. Think of the equity risk premium as the extra paycheck an investor demands for doing a highly dangerous job.
Okay.
Holding a U.S. Treasury bond is like having a safe, predictable desk job. That is your risk-free rate.
Got it.
Holding equities is like working a dangerous construction job. You demand a premium, an extra return, to justify taking on that danger. And going into Tuesday, the risk-free rate was already elevated near 4.3%.
So the foundation of stock valuation was already under heavy pressure.
Exactly.
And when the president threatens global destruction, what happens to that required paycheck?
Oh, it skyrockets. When fear spikes, there is a sudden systemic demand for downside protection. Investors collectively decide that the danger of holding stocks has multiplied.
Which forcefully expands the equity risk premium.
Precisely. And when you add an expanding ERP on top of an already high risk-free rate, the overall cost of equity capital rises dramatically.
Forcing a massive multiple compression.
Right. To give investors that higher required return, the price of the stock has to drop. So this happens mechanically, even if the underlying companies themselves are perfectly healthy.
It is a re-rating of risk, not a judgment on a company's balance sheet.
Exactly.
That makes perfect sense. But then we get to the afternoon, and the entire narrative flips. We get a late session lifeline.
Yeah, massive shift in tone.
At 3:39 p.m. Eastern Time, which, for context, is 12:39 a.m., local Pakistan Standard Time on Wednesday, Pakistan's Prime Minister formally requests a 2-week extension to Trump's deadline, urging a temporary truce.
And it's important to note, the formal White House confirmation that they are reviewing this request came slightly after the closing bell at 6:19 p.m. Eastern Time.
Right. But that 3:39 p.m. headline alone sparked a spectacular relief rally.
Because it provided a credible off-ramp. Financial markets just need a credible path away from the absolute worst-case scenario.
And the closing numbers reflect pure exhaustion and relief. The S&P 500 staged a miraculous recovery to finish up 0.1%.
Erasing all of those morning losses.
Exactly. The Dow erased most of its 400-point deficit to close down just 0.2%, and WTI crude retreated to settle at $112.95. The 10-year yield also eased slightly to 4.3%.
It was a massive intraday swing.
So was this afternoon recovery based on a fundamental change in the economy, or was it purely an emotional relief rally compressing that equity risk premium you just explained?
It was entirely the latter. The underlying U.S. economy did not structurally change between 9:30 a.m. and 4 p.m.
Right.
What changed was the rapid compression of that equity risk premium. As the de-escalation narrative took hold, systemic fear cooled, and the required premium for holding risk shrank back down.
Triggering an automatic upward re-rating in prices.
Exactly.
Pure emotional whiplash. So diplomacy saved the afternoon, but corporate fundamentals secretly cushioned the morning fall. We'll pause here. When we return, we'll look at the specific companies that held the market together today, share a quick laugh, and preview what to watch tomorrow.
See you in a minute.
And we are back, moving into our final session, corporate events recap and what to watch next.
So while the broader macro index was tied to headlines today, specific sectors were providing vital structural support beneath the surface.
Acting like secret cushions.
Exactly. And this largely ties back to the ongoing $690 billion AI infrastructure supercycle.
Right. Let's get into the specifics of that support. On the tech side, we have Broadcom and Anthropic. So at 5:30 p.m. Eastern Time on Monday, April 6, Broadcom filed an SEC 8K.
Disclosing an unprecedented deal.
Yeah. They are going to supply Anthropic with 3.5 gigawatts of TPU compute capacity starting in 2027.
And we need to pause on that 3.5 gigawatts figure.
Yeah, that is not just a standard tech spec. That is the equivalent amount of electricity required to power millions of homes. Broadcom shares surged 6.2% on Tuesday.
Which sent a clear signal to the market that these massive hyperscale capital expenditures are completely locked in, regardless of what is happening in the Strait of Hormuz.
Offering massive support to the tech complex. And they had another pillar of support today, too. At 9:29 a.m. Eastern Time, quite literally as the market was staring down that opening bell plunge, Intel announced they're joining Elon Musk's Terafab project alongside SpaceX and Tesla.
Pushing Intel up over 2%.
Right.
And this shows tangible physical movement in securing a U.S.-based AI and robotics compute supply chain, completely isolated from Middle Eastern shipping lanes.
But it wasn't just tech acting as a life raft. Let's shift to healthcare. At 6 p.m. Eastern Time on Monday, April 6th, CMS finalized the 2027 Medicare Advantage payments.
And they announced a surprisingly high 2.48% net average increase.
Which was a total shock to the upside. It caused UnitedHealth to rocket 9.4%, and Humana shot up 7.9% during Tuesday's session.
Because when the market is blinded by geopolitical uncertainty, it will fiercely bid up any asset that offers guaranteed government-backed cash flows.
And since a behemoth like UnitedHealth carries tremendous weight in the index, its 9% rocket physically prevented the broader index from crashing.
It acts like a massive ballast.
You know, it makes me think of an analogy. If the geopolitical headlines, the missile strikes, the oil shocks, are a violent surface hurricane tossing the boats around on the ocean, these massive AI infrastructure commitments and regulated healthcare cash flows feel like the deep, silent ocean currents actually dictating where the water is moving underneath.
I love that analogy. It's perfectly fitting.
But my question is, if inflation stays sticky, is this reliance on brute force earnings expansion actually sustainable?
Well, that is the defining existential question for the market right now. With a structurally higher risk-free rate, multiples are naturally compressed.
Right.
So the only way the overall market stays afloat is through that brute force earnings expansion. The actual cash flows generated by the AI revolution and the healthcare sector have to be so physically immense that they outpace the higher cost of capital.
And so far, those deep ocean currents are proving strong enough to fight the surface hurricane.
They absolutely are.
Well, the whiplash today was certainly one for the history books, which brings us seamlessly to our mandated closing bell joke from today's recap notes.
Well, I'm ready.
We started the morning with warnings that our entire civilization might end tonight, but the S&P 500 still miraculously managed to close in the green.
Yeah, that is Wall Street for you.
Thankfully, Medicare Advantage finalized those higher payment rates today because surviving that massive intraday swing definitely gave every trader heart palpitations. Here is to surviving another wild day on Wall Street, proving once again that not even the threat of global destruction can stand in the way of a good tech and healthcare rally.
It really captures the gallows humor of the trading floor today.
It does. So as we look ahead, what are the critical items we need to watch over the next 24 hours?
There are 5 critical items from the macro context that you need to watch. First, we are waiting for the formal White House decision on Pakistan's proposed 2-week Iran deadline extension.
Okay, that's huge.
Second, we have the U.S. FOMC meeting minutes release. Third is the Reserve Bank of New Zealand interest rate decision.
Got it.
Fourth, we need to closely watch the U.S. 10-year Treasury note auction results. And fifth, we are actively monitoring for any Iranian military response to the recent U.S. airstrikes.
A lot to keep an eye on.
Yeah.
As we wrap up, what is the core takeaway the listener should be focusing on heading into tomorrow?
I want to leave everyone with a final thought to mull over regarding those deep ocean currents you mentioned. We've established that the market is relying entirely on brute force corporate earnings to stay afloat.
Right.
But here is the vulnerability. Those future AI earnings require physical infrastructure, steel, power grids, silicon. If global supply chains are disrupted enough by the Middle East conflict that the AI infrastructure build-out physically stalls, will those deep ocean currents still be enough to save the market from the hurricane?
Wow. That is exactly the kind of structural question you need to be asking as we head into tomorrow's session. We would love to hear how you are processing all of this, so please share your thoughts on today's wild swings and what you think happens next down in the comments.